This week I made 5 different trades, with 4 of them being straddles and 1 of them being an outright directional play. The 5 stocks were Dutch Bros, Newmont Mining, Rivian, Block, and Nvidia. Yes, as I said last week, I did short Nvidia. I was also careful to take into consideration all the lessons that I learned over the last couple of weeks. In other words, I started being more careful about what kind of spreads I was buying, making sure that I was mirroring both on the puts and the calls so that I could get the same amount of profit, and being careful about how much money they were all costing, so that if the trade went completely belly up, I wasn't left into a position where I was losing a lot more money than I wanted to. As always, the amount of money I'm putting at risk is very small. I'm using tiny options trades. And even though I hold positions on all of the plays that I'm making, these plays aren't going to protect me in either direction. My positions are significantly larger. But as I've said for the last couple of weeks, my goal here is to get better and better at making these trades work out. Once I've got myself into a position where I'm making consistently successful trades, then I can worry about scaling, increasing the size of the trades, and getting more of the profit of the trade. You can see that I redesigned the spreadsheet once more. I realized that I was bouncing between 2 sections, and that was completely unnecessary since both the call spreads and the put spreads make up one trade. Why would I jump from the call section to the put section? It makes much more sense if they're right next to each other. First up, we'll talk about the Nvidia put spreads. I actually bought put spreads that were about 25% down from where Nvidia was trading before earnings. Now that might sound insane, but believe it or not, in Nvidia's past, it has sold off 25% in a week and a half. Which reminds me, I'm no longer buying the options that expire in the same week's Friday. Instead, I wanted to give more time frames, so all of the options I was buying expire on Friday, March 1st. When Nvidia came out, it blew away expectations, even though all the bears thought it wasn't possible. And Nvidia ended up skyrocketing. Given that Nvidia is the largest position in my investments in play portfolio, I had no problem losing the $15.08 that it cost me to put on those put spreads. If they had paid out, I could have made $484.92 in profit. 3,216%. But like I said, even that amount wouldn't have saved my position in investments in play. It's that big. It's absolutely huge. And there's no way anything I can do in this portfolio can cover any of the positions that I hold. However, making more than 30 times my original investment would have been pretty entertaining had Nvidia actually sold off. But it didn't. They expired worthless, and that's A-okay by me. Next, looking at Dutch Bros, I bought the 32-33 call spreads and the 24-23 put spreads. So there was $1 difference between both. In its past, Dutch Bros has moved more than 15% within a week and a half after earnings in either direction. So I thought it could do this move this time too. But as you can see in the 5-minute chart after Dutch Bros reported earnings, it had really weird price action. Dutch Bros did beat on earnings, and it gave reasonable guidance, also saying that it was pulling back on its amazing growth. In other words, it wasn't going to open too many stores too fast, and all of this was good news. However, maybe it's because of the economic climate or how competitors like Starbucks are doing. Dutch Bros just ended up trading in a range after earnings and never printed either the calls or the puts. As you can see, it rocketed higher immediately after earnings before giving back almost all of that move the day after earnings. Then the day after that, it did relatively the same thing. And on Monday, it finally did rally higher, but it's still nowhere near where it needs to be to print those call options. At the recording of this video, it is Monday, so there are 4 more days left before these options expire. But it's going to take a pretty significant positive or negative catalyst to make these options print in either direction. That being said, if something interesting happens between now and Friday, I'll cover it in the next episode. Next up, we have Newmont Mining. Now, I know a couple of weeks ago I said I wasn't going to play Barrick Gold, and this is just another gold miner. However, Newmont was having some trouble going into earnings, and I thought it might move in either direction, particularly since we already saw the movement in gold sell off into Barrick Gold's earnings. I felt that that price action had kind of steadied, so going into Newmont Mining, I did decide to put on a play. I bought the $34.50 $35 call spreads and the $31.50 $31 put spreads. Once again, mirroring in either direction. That means the most I can sell either of them for was $50. Newmont reported before the bell on Thursday, and although they beat on earnings, they gave very dismal guidance and more bad news. Newmont has been mismanaged for some time, and they announced that they had to cut the dividend, which is one of the big reasons people invest in the gold miners to begin with, so the stock really sold off. As you can see, it made my put options fully profitable. However, there was so much bouncing around, and the underlying asset of gold can move so quickly that I decided it was time to take profits when they became profitable. You can see that on Thursday after it reported earnings, it immediately came down and printed the put options. But on Friday, Newmont bounced and got above the put option that I was long. And I didn't want to have these expire worthless, so Friday was when I decided to sell, even though you can see if I waited until Monday, they would have become fully profitable. I sold the put options for $36.92, which means I locked in a gain of $11.76, or a profit of 46.74%, which is pretty good. Granted, I could have made a maximum gain of $24.84, which would have been 99% profit. However, I felt like this was pretty good. Even though Newmont ended up selling off on Monday, I'd rather lock in the gains when I have them than have them lost. As I always say, you need to take profits when you have them, otherwise the market will take them from you. And we'll actually see exactly what I was talking about in a later trade. Next up, we've got Rivian, the EV maker. Rivian is considered the second best EV maker behind Tesla. However, it's a distant second. So the stock tends to be incredibly volatile after earnings in both directions. Even though when Tesla reported earnings, they said that there were significantly less demand for EVs than anyone had expected, I thought there was a chance that Rivian could actually impress on earnings. So I still wanted to do the straddle and cover both directions. I bought the 1750-18 call options and the 13-1250 put options to make my straddle. In both directions, this was a movement of less than 20%, which Rivian pretty much does almost every single time it reports earnings within the next week and a half, either up or down. Initially, when Rivian reported earnings, you can see there was a brief pop because they did beat revenue expectations for the quarter. However, when they came out and gave guidance, it wasn't just bad, it was terrible. Rivian had to come out and strike down all of their production targets for the year of 2024, which meant they lowered their guidance for the remainder of the year. Now, although the CEO came out and reassured investors that they have enough money to survive long enough to make it through this EV winter, the investors were not so certain on this. Rivian positively imploded after earnings and sold off dramatically. As you can see, Rivian gapped down the day after earnings, which fully printed the put options, except you don't get full profit unless you're closer to expiration. The problem with buying these options that expired a week from Friday instead of on Friday meant that I had to hang on to them a little bit longer so that I could get more profit. And on Friday, they sold off even more, making a new all-time low at $10.06. Given that the most I could sell those Rivian put spreads for was $49.92, on Friday I decided to lock in the gains and sold them for $43.92. This meant I made a profit of $18.76, or 74.56% in gains on the cost of the puts and the calls. It's important to remember that for each of these trades, the profit and loss that I have listed includes the cost of both the calls and the puts, not just the options I sold, but the entire trade. Given that I almost captured the entire amount of profit that I could have had, $24.84 was the max, and I got $18.76, this was definitely a win, even though Rivian ended up selling off much more, and I probably could have gotten max profit if I waited. The last trade that I put on was on Block, the fintech provider that I've been invested in since 2016. Block is incredibly volatile, so I did buy the calls and puts that were pretty far out. Both of them required a move of nearly 20% before they'd be profitable. But this is not remotely unusual for Block. It does that almost every single time it reports earnings. I bought the 76-77 call spreads and the 54-53 put spreads. When Block first reported its earnings, you can see there was an immediate knee-jerk reaction down. And that was because they missed on earnings per share. However, their revenue was so much bigger than anyone expected, and their gross profit was so huge that the stock positively rocketed to the upside. The funny thing is that although Block ended up rallying on Friday and totally made my call options print in terms of the amount of movement I needed, you could see that if I had waited until Monday, Block ended up selling off below the call spreads that I own. I ended up selling my spreads on Friday, even though it wasn't close to the full amount of profit, just because of that old adage I keep coming back to: take profits when you got them, or else the market will take them from you. And you can see this is exactly why I made up that saying to begin with. You never know what's going to happen after you have a profit, especially when you're playing a binary outcome like earnings. If I've got a profit to take, I want to lock that in. Now, it's possible that between now and when these options expire on Friday, that Block ends up going back over where I need it to go to make my calls profitable. However, I don't have to worry about that because I sold them on Friday. I sold my call options for $65.92, which means I made $33.76 in profit, a gain of 104.98%. Now, of course, the max gain I could have made was 211%. I could have gotten a max profit of $67.84 instead of $33.76. But as you could see from the price action that happened on Monday, it turns out it was a good thing I locked in those gains. So overall, this week, I ended up putting $126.72 on the line and ended up walking away with $20.04. A gain of 15.81%. Out of the 5 trades I did, 3 of them came in as winners, which means my win-loss ratio for last week was 60%. Now, since the Dutch Bros options don't expire until this Friday, there is still a slim possibility that that trade could become profitable, but I'm not counting on it. I'm plenty happy with the 60% win-loss ratio. Additionally, you can see that overall, from the 4 weeks that I've been trading, I've put $449.10 on the line, and I am down $70.70, which is a loss of 15.74%. But since I am just getting started, that's not too bad at all, especially when you look at my win-loss ratio, which is now at an average of 55.56%. In fact, if you just look at the straddle trades, I've put 14 on, I've won 9 of them, and that gives me a win-loss ratio of 64.29%. Now, even with that kind of success, which I'm plenty happy with, I have to wait a little bit longer before I do anything in terms of scaling. There's just simply not enough trades made here yet for me to be able to count on that win-loss ratio going forward. Next week, I have 2 possible earnings trades that I can do: Salesforce and Snowflake, and both of them report Wednesday after the bell. However, I've been looking at their options and both of them are incredibly expensive, so I'm not entirely sure that I'll make either of those plays. But I have a surprise trade that I've already put on. Like I said, this video is being recorded on Monday, and I actually put a directional bear play on the S&P 500 using put options on the SPY. We get 2 key pieces of information about the economy: the Personal Consumptions Expenditures Index, or PCE, and the GDP for the 4th quarter of the United States. The PCE is the Federal Reserve's preferred gauge of inflation, and it's been showing that inflation has been coming down in recent months. But if it comes in hot, that will absolutely be a negative catalyst for the stock market. Additionally, if GDP comes in weaker than expected, that will be negative too. So if both come in worse than expected, that will absolutely be a reason for the stock market to sell off. And the put spreads that I bought only require the market to sell off 0.78% for them to become fully profitable. So stay tuned for next week, where we get to see whether my SPY puts pay off and whether or not I do the trades on Salesforce and Snowflake.